That house you're saving up for right now, it might be the single most expensive financial mistake you ever make. And the terrifying part is, by the time you realize it, you'll already be locked in. Here's the thing, I'm not here to tell you homeownership is bad. It's not. For a lot of people in the right conditions, at the right time, it's one of the best things they ever did. But this isn't that time, and most people have no idea why. Because nobody in the industry that profits from you buying a house is going to explain it to you. Your realtor isn't. Your mortgage broker isn't. Even the financial content you've been consuming. It was probably written 3 or 4 years ago when the numbers told a completely different story. So what changed? Almost everything, actually. Interest rates shifted. Home prices didn't come back down the way people expected. And something else happened. Something quieter. Something most buyers never even look at. That turned what used to be a solid financial decision into something closer to a trap. And the dangerous part isn't that people are walking in blind. The dangerous part is that they're walking in confident. They've done the research, they've run the numbers, they feel ready. That confidence, that's exactly where the problem lives. Let me ask you something. Why do you actually want to buy a house? Take a second. Not the answer you'd give someone else. The real one. Because for most people, it's not purely financial. And that's not a criticism. That's just honest. There's something deeper happening. Something that has nothing to do with interest rates or equity or appreciation percentages. It's the feeling. The idea of having something that's yours. A place where you can paint the walls whatever color you want. Where nobody can raise your rent in January and smile while doing it. Where you feel like you've finally arrived. Like you've done the thing adults are supposed to do. And here's where it gets psychologically interesting. That feeling, that desire, it's not random. It was built into you, deliberately, over decades. Through every conversation where someone said, stop throwing money away on rent. Through every family dinner where homeownership was treated as the obvious next step after marriage, after the job, after the baby. Through every advertisement that showed a happy family standing in front of a house with a sold sign, looking like they finally figured something out. You absorbed all of that, without realizing it. And now, when you sit down to make what feels like a rational financial decision, you're not starting from zero. You're starting from a place that already has an answer built in. The analysis you run, it's unconsciously designed to confirm what you already feel you're supposed to do. Psychologists call this motivated reasoning. You don't start with the question and find the answer. You start with the answer and find reasons that support it. And the real estate industry knows this. They've known it for a long time, which is why the marketing was never really about numbers. It was always about identity, about who you become when you buy, about what it says about you, about how it feels to hand over that down payment and call yourself a homeowner. That emotional charge, it makes you easier to sell to. It makes you less likely to ask the uncomfortable questions. It makes you overlook things you'd catch immediately in any other financial decision. Think about it. If someone came to you and said, I want you to tie up a significant portion of your savings, take on hundreds of thousands in debt, pay interest for the first decade before you barely touch the principal, and lock yourself into a single asset in a single location for the next several years, would you say yes? Probably not. But frame it as buying your dream home. And suddenly it sounds like the smartest thing you've ever done. That's the gap between how this decision feels and what it actually is. And I'm not saying don't buy a house, ever. I'm saying right now in 2026, with the conditions that actually exist, you need to see this decision for what it is before you make it. Not what it feels like. Not what your parents did. Not what your friends are doing. What it actually is. And when you strip the emotion out and look at the mechanics, the picture is uncomfortable. Let's talk about the actual numbers. Because this is where most people's understanding of homeownership starts to fall apart. When someone tells you buying a house builds wealth, they're not lying. But they're also not telling you the whole story. They're showing you one side of a ledger and quietly folding the other side under the table. Here's what they show you. You buy a house for, say, $300,000. 10 years later, it's worth $400,000. You made $100,000. Homeownership works. Story over. Except that's not how any of this works. Let's actually follow the money. You put down $60,000. That's your 20% down payment. You take on a mortgage for the remaining $240,000. In 2026, depending on where you are, you're looking at an interest rate somewhere in the 6 to 7% range. Maybe slightly under if you're lucky. Maybe slightly over if you're not. At 6.5% on a 30-year mortgage, do you know how much interest you pay over the life of that loan? Around $306,000. You borrowed $240,000. You pay back $540,000. That delta, that $300,000, that's not building wealth. That's the cost of access. That's what you pay for the privilege of living in a house you technically own. And most people have never sat with that number long enough to feel it. But wait, the house appreciated. You made $100,000 in equity over 10 years, remember? Yes. And you also paid roughly $110,000 in interest during those same 10 years. Because in the early years of a mortgage, the overwhelming majority of your monthly payment is interest, not principal. Interest. So in year one, on that loan, maybe $60 or $70 of your monthly payment actually reduces what you owe. The rest goes to the bank. Most people don't know that, or they know it vaguely, the way you know something you heard once but never really looked at directly. And we haven't even started on the other costs yet. Property taxes. In most places, that's 1 to 2% of your home's value every single year. On a $300,000 home, that's $3,000 to $6,000 a year. Every year, whether you have a good year financially or a bad one, whether the roof needs replacing or not, it just comes. Then there's maintenance. The real number, the one financial planners actually use, is roughly 1 to 2% of the home's value annually. Some years it's nothing. Then the HVAC dies. Then the water heater. Then you discover the gutters have been quietly destroying your fascia boards for 3 years, and now it's a bigger problem than it needed to be. That's another $3,000 to $6,000 a year on average when you smooth it out over time. Add homeowner's insurance, add PMI if you put down less than 20%. Add the closing costs you paid up front, typically 2 to 5% of the purchase price, which you never get back and which most people don't include when they calculate their returns. When you add all of that up, the interest, the taxes, the maintenance, the insurance, the closing costs, the actual cost of owning a $300,000 home over 10 years can easily exceed $500,000. And here's the part that really lands differently when you see it clearly. That $60,000 you put down as a deposit, if you had invested it in a diversified index fund at historical average returns, over 10 years, that money could have grown to somewhere between $110,000 and $130,000 without the debt, without the maintenance calls, without being locked into one location. That's not a knock on home ownership in general. That's a specific observation about what the math looks like right now, in this market, at these interest rates, with these prices. Because here's the thing that changed. For most of recent history, buying made more mathematical sense because interest rates were low. When rates were at 3%, the interest cost was manageable. The math tilted in favor of buying, especially in markets where rents were rising fast. But that window closed. Rates moved. Prices didn't come down proportionally, which means you're now paying 2021 prices with 2024 borrowing costs. And that combination, it doesn't math the way it used to. And yet the cultural pressure to buy hasn't moved an inch. The advice people are giving each other is the same advice that made sense 5 years ago. The emotional pull is just as strong. The industry is just as motivated to close deals, but the underlying reality is different now, and most people walking into a mortgage in 2026 haven't stopped long enough to notice that. There's another layer to this, and it's the one people resist the most. Liquidity. It sounds like a finance word. It's not really. It's just freedom. The ability to move, to pivot, to respond to your life as it actually unfolds. Not as you planned it would when you were signing documents at a closing table. When you buy a house, you don't just take on debt. You freeze yourself in place. And in 2026, that's a bigger problem than it's ever been before. Because the economy right now is not stable in the way it was for previous generations. Jobs move. Industries shift. The career someone builds in one city can disappear, or evolve into something that exists somewhere else entirely. Remote work opened a door. And then that door started closing again. Companies are calling people back. Some aren't. Some don't know what they want. And the people caught in the middle of that uncertainty, the ones who bought houses based on assumptions that no longer hold, they're stuck. Not metaphorically, literally. You can't just leave a house. Selling costs money, typically 6 to 10% of the sale price in agent commissions, closing costs, transfer taxes. If the market moves against you, even slightly, you can end up selling for less than you owe. That's not a theoretical risk right now. That's a documented reality in certain markets across the country. And the opportunity cost of being stuck, of not being able to take the job in a different city, of not being able to downsize quickly when your income drops, of not being able to make aggressive financial moves because all your capital is sitting in four walls that you can't liquidate without a 3-month process. That cost is invisible. It doesn't show up on your mortgage statement, but it's real. And in a volatile economy, it's enormous. Here's something most people don't let themselves think about. The generation before us, they bought houses and it worked out. Property values climbed for decades. Interest rates fell for decades, which means anyone who bought could refinance into a cheaper loan later. Wages grew steadily relative to home prices. The math rewarded buying. Consistently, over a long enough timeline that it became cultural truth. Homeownership builds wealth. Homeownership is the responsible move. Homeownership is the thing you do. But they had tailwinds. Specific historical tailwinds that don't exist in the same way today. We're not in that environment anymore. And this is the part that's genuinely hard to sit with, because it means the advice you receive from people who love you, people who were trying to help you, people who built their own financial stability through homeownership, that advice might not apply to your situation in this moment. With these numbers, that doesn't mean they were wrong. It means the world changed. And here's the emotional truth underneath all of this. Buying a house feels like safety. It feels like you're doing something permanent in a world that feels increasingly temporary. It feels like an anchor. And when everything around you feels unstable, economically, professionally, socially, the idea of planting a flag somewhere and saying, "This is mine, this doesn't move," that's deeply human. That pull is real. But sometimes, the thing that feels like an anchor is actually a chain. And the question worth sitting with, the one most people avoid because it's uncomfortable, is this. Are you buying a house because the numbers make sense right now? Or are you buying a house because you're afraid and the house feels like the fear has somewhere to go? There's no judgment in that question. I'm asking it because it matters, because the answer changes everything about whether this decision serves you or whether you end up serving the decision for the next 30 years. The trap isn't the house, not really. The trap is making a 30-year financial commitment from a place of emotional urgency, without fully understanding that the conditions have changed, the costs are higher than they appear, and the freedom you're giving up has a price that doesn't fit anywhere on the paperwork. That's the part nobody puts in the brochure. So, where does that leave you? Not with a simple answer. I'm not going to give you one, because there isn't one. Anyone who tells you never buy a house is just as wrong as anyone who tells you always buy as soon as you can. The truth lives somewhere in the middle, and it's specific to your income, your market, your timeline, your flexibility, your actual financial position stripped of all the emotion around it. But here's what I want you to take away from this. The question is not, should I rent or should I buy? That's the wrong question. That's the question the industry trained you to ask because it leads you toward a transaction either way. The real question is, what is this decision actually costing me? All of it. The interest, the opportunity cost, the liquidity I'm giving up, the flexibility I'm trading away, the assumptions I'm making about where my life will be in 5 years, in 10 years. Assumptions that may or may not hold. When you ask that question honestly, the answer gets harder, but it gets real. And real is what protects you. Because here's what actually happens to most people who buy in the wrong conditions, at the wrong time, for the wrong reasons. They don't lose everything dramatically. It's not a collapse. It's quieter than that. It's just a slow, grinding constraint. Month after month of a payment that's slightly too large. Year after year of maintenance costs that chip away at everything else. A job opportunity passed up because moving isn't realistic. A financial pivot that never happens because all the capital is locked in the walls. It's not a disaster. It's just a smaller life than they could have had, and most of them never connect it back to that one decision, because it happened slowly, because the house is still there, because on paper, the asset exists, but the freedom they traded for it, that doesn't come back. Look, maybe you're in a position where buying actually makes sense right now. Maybe you've run the full numbers, not just the monthly payment. Maybe your market is different. Maybe your timeline is long enough, and your income is stable enough, and your down payment is large enough that the math actually tilts in your favor. If that's you, genuinely, then none of this should stop you. But if you're buying because it feels like the right time, even though the numbers are tight, if you're buying because everyone around you is buying, and you're afraid of being left behind, if you're buying because renting feels like failure, and you need the house to feel like you've made it. Slow down. Just slow down. The market will still exist in 6 months. The houses will still be there. But the decision you make from a clear head, from actual numbers, from honest self-awareness about what's driving you, that decision is one you can live with. The one made from fear or pressure or social comparison. That one has a way of quietly following you around for a very long time. Most people will hear all of this and still miss it. They'll nod, they'll feel something for a moment, and then the emotional pull of the house, the approval of the people around them, the fear of renting forever, it'll all come rushing back in, and they'll sign the papers anyway. But a few people watching this will actually sit with it. They'll run the real numbers. They'll ask themselves the uncomfortable question about what's actually driving the decision, and they'll make a choice that's genuinely theirs, not one handed to them by an industry or inherited from a generation that lived in a different economic reality. If you're one of those people, you already know what to do next. And if you want to keep thinking clearly about money, about how it actually works, not how it's marketed to you, then stick around. That's all I make here. No noise, no hype. Just the stuff that actually matters.